All right, so good evening, and then welcome to another lecture for the financial management course. Um, to recap what we did in our last meeting, we started to look at how to value securities. Again, we mentioned that our securities could either be debt securities or equity securities, so shares or what, or bonds or debentures. So we learn how to value. So how do we price a share? How do we price a bond? Then when we were done with that, we came to look at what's the cost of the cost of debt, cost of equity, right? And those were the things that we looked at in our last meeting. Now today we are saying that for the company as a whole, if they source their finance from equity sources or they source their finance from debt sources, what is the cost of all their capital, right? And that is basically the weighted average cost of capital. So the formula basically is going to take you through what the cost of the various capital sources are, and then we weight them. Okay, so by weighting, we want to find their average. Now, the formula you are going to see in the formula sheet to help you calculate that is this. You can clearly see. Okay, so you have the work formula, and this is what you see over here. So here, this formula is assuming that the company is using equity, right? That's your common shares. And then here you have the value of, or you have preference shares. So again, we saw that one of the sources of finance is what is the preference shares. And then what you have here is what is the debt, which will be your bonds and so on and so forth. So this is basically what the formula is looking at. That is, we are using three sources of finance. But the one I have here in your lecture notes is looking at a situation where we even have what, four sources of finance. And when you look at it carefully, this one is for your common equity shares. This one is for your bond, right? Your bond or debenture with your debt. This one is your preference shares. And then sometimes the company can even go in forward a bank loan, right? And clearly, bank loan is also a debt financing source, but it is quite different from what your normal bonds, okay, which is also a source of debt finance. So that is why we have the two here. Now you can see that when it comes to the cost of the bond, for example, and the cost of the bank loan that you're going to take, the cost of them, you see that there's this expression 1 minus t, which is to tell you that for debt finance, whether it's a bond, it's a loan, right, normal bank loan, or a debenture, whatever you call it, the cost of debt that we are looking at is the after-tax cost of debt. And in the last meeting, we explained why that is so, right? We spoke about the fact that for debt finance, the company is able to enjoy some tax benefits. Okay, so clearly it helps to reduce their financing costs. Okay, once you take out the tax, it helps to reduce their financing costs. So that is what we have here. So here we are just trying to explain what these things you are seeing here: VE, KE, VD, VP, VB. What do they mean? So here you have the value of equity. VD is the value of debt, right? VP is the value of the preference shares. VB is the value of the bank loan. KE, like we know, is the cost of equity. KD 1 minus T is what? The after tax. So 1 minus T, the T stands for tax. So after you have taken out your tax, what is the cost of debt, or how much interest do you have left to pay? That is what we have here. You have the cost of preference shares, and then also for the bank loan, you have the after-tax cost of the bank loan. So that is basically what makes up what this entire formula that we have here. Okay, very straightforward. Like I said, in your paper last night, one of the questions required you to calculate the weighted average cost of capital. I think that would be the question 2. Okay, so you see the person here trying to do the work formula, right? So that is this. So we definitely have this over here. Okay. So once we are done with the main questions that we have, we can even try to attempt. It's just for 2 marks. So you can see how simple and straightforward that it can be. So let's solve the questions that we have. Then we can attempt what you had in your exam last night. Okay. Just to help solidify our understanding. All right. Let me show it. Okay. So almost always, so we have the weighted average cost of capital, right? So example 1, John PLC is financed as follows. So it means that the company has the following sources of finance. So it has equity, and for the equity, it has 5 million 1 CD shares, and I've explained what this 1 CD means. That's the nominal value of what each share, and it is quoted at 2 CDs, 50 pesos, cum dev. So this is the share price, but it's a cum dev share price, and I told you something about what to do. And we are saying on which there is expectation that a constant dividend of 32 pesos per share is about to be paid, right? Then also the company has debt finance, and that is it has 4 million, and this is again the total nominal or face value of the bond, right? And it has a 8% coupon rate. Now, this debenture is quoted at 92 CDs per bond. So this is the current market value of the bond. So the bond is sold at a discount. All right. Corporation tax is 30%. A, we are asked to calculate what? The returns on equity, or the returns towards investors on equity and on debt. Okay. So that is what we need to find out. So we want to find RE, which is the shareholders required rate of return. And then we'll also find KD, which is what? The investors required rate of return. That is the first question. All right. So let's look at getting that. So for RE, if you go to the formula sheet, RE will be DO over what? Over PO. Okay. And we said that this PO, or the price of the company share for your paper, is supposed to be what? The ex-Dave share price. So if they've given you the cum Dave share price, you need to what? Find the ex-Dave. So our ex-Dave share price is going to be the cum Dave share price of 2.5. So this is 2 cities, 50 pesos. Now we are going to deduct the 32 pesos from it. Now this 32 is in peso terms. If you want to change the pesos into cedis, what do? You divide the 32 over 100. So that will give you what? 0.32. So 0.32 cedis, which is the same as 32 pesos. Then that at the end of the day will give you an ex-Dave share price of 2.18 cedis per share. So now that you have the ex-Dave share price, your shareholders' required rate of return will be the dividend per share, which is 0.32, because we want to work in CD terms, and we divide that by what? 2.18, right? Which is the share price. And when we divide that, the shareholders' required rate of return will be
0.147.
all right. So that'll be 14.7. So please remember it's a percentage. Okay. The return is a percentage. Yes. So that's what you have. Okay. Then we also have what do we call it? External investors who provided us the debt. So at the end of the day, we also have to find what the return to the investors. Now, remember, the return to the investors, we are saying it is not the after tax. I hope you remember that. Okay. But if we are looking at the company's cost of debt, that is where we have to factor in the tax element. So KD here is the what? The return to debt investors. So I took time to explain that when it comes to equity, this RE is the same as what? The KE. But for debt, this KD is not the same as KD 1 minus T. I explained that. Okay. So we can refer to the previous lecture. Now, to find the return to the debt investors, the formula will tell you that it is your coupon, right, which is the interest over the price of the debt, right, which is the MVD, or it's, the book will say P naught, okay, or the price of the debt, whatever it will be, right? Okay. Now, the coupon, as we know, is the coupon rate, which in this question we're told is what? 8%. Okay, 8% on the par value of one bond. So again, I always tell you that we are not looking at the 8% on the total amount here. We are just interested in just one. Okay, and that is the angle that I would like you to take it. I know that when you even look at your past questions, sometimes the solutions they provide, they look at it in total. You are not wrong if you look at it what per one bond. Okay, which is how I like to teach. I hope that is clear. All right. So one bond, like I've told you, has a par value of what? Of 100. Okay, unless you are told otherwise. So that would be 8% over 100 all over the price of the bond, which we know to be what? 92 cedis. So that'll be 92. And so at the end of the day, this will be what? 8 over 92. And that'll give us a return of how much?
8.7%.
All right, 8.7%. Okay, great. Then we come to B, which is calculate your WACC. Okay, now always have a checklist. Okay, have a checklist. So you ask yourself, what is the value of equity? What is the value of debt? What is the cost of equity? And then what is the after tax cost of debt? These are all the things you need for your work. So the value of equity we are talking about here is the total market capitalization of the company's what? Equity. So what this means is that we will need to know how many shares that the company have in circulation. We are being told that they have 5 million 1 CD shares. Okay, so they have 5 million units of the shares in issue. Okay, of the shares in issue. And then each share has a price of what? And so please again remember, we always use what? The ex-div share price. And from the earlier working, we've said that the ex-div share price is 2.18. Okay, so don't do the mistake of using the cum div share price. I hope that is clear. So 2.18. So when we multiply this, That will give us the total market value of the company shares. And that is how much?
10.9. So 10.9
All right.
million.
All right. So that is 10.9 million cedis. Okay. This is money. Okay. Then when we look at the value of debt, like I've also told you, the bonds, the 4 million we have here in total meant that there was some units of the bond that were what put out for issue and people bought them. Okay. And all of these bonds had a par value of what? Of 100. And so the question is, how many units of the bond were issued to raise the what? The total 4 million Ghana cedi face value that we are having over here. So that would be the 4 million cedis. So remember, 4 million, right, divided by 100. Okay, so that will give us the number of units of the bond that we have in issue. Now, once we find the number of the units of the bond in issue, we can multiply that by what? The current market price. And that will give us the current market value of those bonds in issue. This 4 million you see here is the face value. The face value or the par value is different from what? The current market value. I want you to get the distinction between the two. All right. So whatever this will give us, if we multiply by the 92 cedis per 1 unit of the bond, it will give us how much? Where's my calculator? Okay, let me
Sorry.
calculate out.
3,680,000.
All right. So 3.68 million.
Okay.
Okay, 3.68 million. All right. So the current market value, like you can see, is much more lower than what the current total face value, right? Just because again, the price is 92, but the par or face value is what 100. That is why the face value, you can see that the value is higher than what the current market value. Okay, right. Then we'll come to the cost of equity. Now, how do we find the cost of equity? Then this is where you get into your formulas. So KE is going to be what? D naught over P naught. Now, like I told you, for equity, what we calculated here as being the return to shareholders, right, which is what we did here, right, is the same as the company's cost of equity. So you can just repeat the 14.7, right, because again, the formula will give you the same thing. So it is 0.32 over what? Over the 2.18, and that'll give us 14.7%. But when it comes to the debt, it is going to change. Now we are going to factor in what? The tax element. So to the company, the formula would therefore be I into bracket 1 minus T over what? MVD. Okay? And so this will be, so you can look at it in so many ways. So 8% by 100 into bracket, right? 1 minus, the tax rate is 30%, I believe, 30. Okay? All right. Whatever you have here, you divide it by what? The market value, which is 92. And then that'll give us how much?
6.09%.
All right. 6.09%. Okay. So we have all the things we need to calculate our work. And so therefore, our work will be equal to, even before that, please add the value of equity, value of debt. Add it for me. What would that give us? This plus this will give us
14.58 M.
40.58 million. All right. So the formula is VE over VE plus VD. So that's what we've done the total for, right? So since this is the weight of equity, we multiply this by what? The cost of equity. Then plus VD over VE plus VD. Then we multiply this by KD 1 minus T. Okay, so remember, it is what we have just gotten here. That is what we are going to fix over here. You don't have to deduct 1 minus T again from this. This is an expression. That is what we have here. Okay, so VE is, I believe, 10.9 over, so the total, which is 14.58. Okay, times the cost of equity, which is 14.7%. And whatever we get plus 3.68 over 14.58, right, by 6.09%. What will be the WACC? Now, to know whether you are going to get the correct answer or a wrong answer, if we say something is an average of two things, it means that the figure should fall between what? The two extremes. So your WACC shouldn't be less than 6% and it shouldn't be more than what? 14.7. When you get anything outside of these two extremes, it means that you are wrong. So please, what will be the WACC?
12.51%.
All right, so 12.51%. Okay, then you can say it's an average between the two. All right, let's look at the second question, and then we can look at what came last night. Okay, for 2 marks, it means that you didn't have to do any extra work. All the figures were given to you to solve. Okay, so Ken PLC is financed as follows. It has equity, which is 10 million 1 CD shares quoted at 3.2 ex-div, on which dividend of 20 pesos per share has just been paid. Now, their dividend is growing at what? At a rate of 8% per annum. You see where it is going. Secondly, they also finance with debt, and they have a total of 6 million CD 10% debenture, which is quoted at what? At 105. It means that the bond is quoted at what? Or is sold at a premium. All right. The debenture is here. Look at it. They say this is redeemable in 6 years' time, and it is redeemed at a premium of what? 10%. Corporation tax is what? 30%. And so we need to calculate our WACC. So what do we need? We need VE, we need VD, we need KE, and then we need KD 1 minus T. Okay? What is value of equity? For the value of equity, we're asking ourselves, what's the number of shares that they have in issue? So they will have 10 million units of the shares in issue. And then each share is priced at what? 3 CDs, 20 pesos. And so that means that we are going to get a total market value of the shares to be what? 32 million CDs. What about the value of the company's debt? They have 6 million total, okay, in terms of the value of the bonds that they've issued. Now, how many units of the bond do they have in issue? That is what we are looking for. So 6 million divided by 100. The 100, again, like I'm saying, is the par value of 1 unit of the bond. Okay. So this expression will give us the number of units of the bond in issue. Then we multiply that by what? The current market price of the bond, and that is 105. Okay, 105. And that therefore will give us a total market value of how much?
6.3 million.
All right, so 6.3 million. Definitely because the current market price is higher than the par value, which is 100 of the bond, then it means that the current market value of the bond is what? It's definitely going to be higher than the total fees value. So that's why we have 6.3, which is greater than what? The 6 million. Okay. All right. So we can sum these two, and this is basically 38.3 million in total. Okay. Now let's come to the cost of equity. Based on what you read, which formula do you think will apply? Who can state the formula for me? Just try. You can even refer to your formula sheet. No problem. Yes.
Working with growth in equity.
Pardon? I
Please,
didn't
can
get
I
what you
just
said.
state the formula for it,
Yeah.
or I would have to say something?
No, just state the formula. What formula? What's the formula to find the company's cost
Okay,
of equity based on what you have?
so
Yes. Mm-hmm.
D not
Mm-hmm.
open brackets,
Mm-hmm.
1 plus growth,
Mm-hmm.
um, all over D not
Mm-hmm.
D plus growth here.
Mm-hmm. Okay. Everything plus. Okay. All right. So the D naught is our current dividend per share, which is 20 pesos. So we want it in CB terms. So we divide by 100, and that'll give us 0.2, right? Into bracket 1 plus the growth rate in the dividend, which we are told is 8% per annum, all over the current share price, which is 3.2, okay, plus the growth rate of 8%. And that therefore gives us a cost of equity of how much? What does it give
14.8%
us?
or 14.75%.
14.8%. Okay. All right. Now let's come to the after tax cost of debt. Now, please remember, since this is a redeemable debt, your formula sheet will tell you that use the IRR approach. That's what you're going to see there. Okay. But I gave you a formula. I hope you remember. Okay. And that's the formula we are going to apply. So the formula will be the after tax coupon, right? Since this is the cost of debt, plus the redemption value minus the price of the bond, right? Which I can say is the market value or the price of the debt, anyhow you want to call it, right? Price of the debt or the price of the bond over n, right? All over 2 by the price of the debt or the bond plus the redemption value, everything over what? Over 3. And I shared how to punch it or calculate it on your calculator for you on the page. Okay, so this is the formula. Now, in this question, we're told that the redemption value is that after 6 years, the debenture or the bond will be redeemed at what? At a premium of 10%. So the redemption value will be the face value of 100, remember? Okay, plus 10%. So this is the expression. And that will mean that the face value will be what? 110 per each bond. Okay, per each bond. All right. Now, if we are to slot everything we have here in the formula, okay, let me also do the coupon rate, right? 10% coupon rate on the par value of the bond, which is 100. Remember, this is the redemption value, like I've stated here. Okay, the par value of the bond is 100. Now, whatever we are going to get, we are going to what, take out the tax of a 30% from it, 1 minus 30%. Okay, so this will give us how much? So this is 70. This will be 10. So this definitely will be what? 7. Okay, 7. All right. The price of the debt or the price of the bond we're told is what? 105. So we have that here, 105. N, which is the tenor of the bond, is what? It's 6. So we have 6 over here. Okay. So now that we have all the pieces, we can what? Put it into the formula. And so therefore, the company's after-tax cost of debt will be 7 plus the redemption value of 110 minus the price of the bond, which is what? 105. All over 6. Everything we have here, okay, over 2 by 105 plus 110 all over 3. And this therefore will give us how much?
Sir, please, I'm not sure, but let me try. 7.34.
7.34%. Can anybody else confirm? 7.34. All right.
7.58.
You are getting 7.58. Okay. I'm sure maybe one or two things could lead to the difference. All right. 7.34, 7.58. We can work around that towards that. So I need at least a 7 point something, right? Okay. Now, another thing I think we'll talk about it today as part of understanding how the level of gearing that the company uses, how it affects the cost of capital. You can see from what we have, this example we are solving, that the cost of equity is 14.8. The cost of debt is 7.58. Cost of debt is lower than the cost of equity. In the earlier example we solved also, you can see the same trend. Cost of equity is 14.7. Cost of debt it was 6.9. Definitely the question we are going to solve, which you got in your past question last night, right? You are going to see the same thing. And the subsequent lectures will explain why that is so. Why the company's cost of equity is always higher than what? Their cost of debt. Okay? All right. So when you get something like this, at least you should know that you are on the right path. Okay? Where the cost of debt is lower than the cost of equity. And so our work will be equal to the value of equity, which is 32 over the total, which is 30, right? All right. I hope you can hear me now.
Yes, sir.
Okay. All right. Let's proceed. I'll do the necessary adjustments. Right. So in continuing, the market value of our debt, that is 6.3. Okay, 6.3 over the total value, which is the 38.3. That is both equity and debt, times the after-tax cost of debt we have at 7.58%. That'll give us a WACC of how much?
Okay. 13.61.
13.61%. All right. Okay. So that is basically about that. So, like I was sharing with you last night, the question being asked you as part of MPV was that calculate the company's weighted average cost of capital, okay, for the project that they wanted to undertake. And that work you were supposed to calculate will be used to do your discounting of what your cash flows. So let's look at the information that relates to that. We are saying, so we are just reading an asset, okay, which is all that we need. Maduro Limited uses after tax weighted average cost of capital to appraise what their investment project. It has a cost of equity of 11%, and it says here what a before tax cost of debt of 8.6. The long-term debt finance of the company on a market value basis will consist of what 80% equity and 20% debt. Calculate the work of what Maduro. So VE, VD, KE, and then what? You need KD1 minus T. Now, instead of them to give you like the money value of what? Of the company's equity or their debt, which will form part of their capital structure, they gave it to you in what? In percentages. So it meant that the company's total money that they have, right? 80% of it, or you can say 80 of it is what? Is equity. So if they have 100 million, 80% will mean that 80 million will be equity, and then 20 million will be what? Will be debt. So that's all that they mean. The cost of equity is what? 11%, which has been given to you. So this plus this will give you 100. Now, we have the before tax. Okay, so what it means is that we have to take out the tax component, and it is told that Maduro has a corporate tax, even though it's 1 year in arrears, the rate of taxation is what? Is 30%. So also with this, it is going to be 8.6%, and we will take out what? The tax of 30% from it. Then we'll get what? Our after tax cost of debt. Once you get that, you can what? Piece everything into your work formula, and that will be what? Your weighted average cost of capital. When you get it, you can then use it to what? Appraise your project using the NPV what? Technique. That is all. I hope this is clear, please. So at the end of the day, what's the after tax cost of debt? 8.6 by 70%. How much would that give us? Please, quickly. Quickly, how much would that give us, please?
6.02.
6.02. All right. So it means that our work will be 80 over 100 by 11%. And again, you can see 11%, 6.02. You can see cost of equity is what? Higher than the cost of debt, right? Okay. So this plus 20 over what? 100 by 6.02%. And that'll give us how much? What's the work? All right. So that's basically about that. Okay. Now,
10 point something.
what did you get?
10%.
You had 10%. Okay, 10%. All right, that's fine. Okay. All right. So that is basically about your weighted average cost of capital. Okay, very simple and straightforward.